Yep. So I'll also release a recording of the presentation. Okay. That might be on YouTube or that might be on our social media. So you can always go back and watch it. All right. And yeah, if you have any questions, please don't hesitate to ask. This whole workshop is designed to be very beginner friendly. So any questions welcome. If you want to ask a question, put your hand up if you're in person, or you can type something to me on Zoom. I should be able to see it. Okay. And I'm going to try to make this as interactive as possible as well. So, everybody gets their fair share of questions. All right. Any questions before I get started on the slides? All right, cool. So yeah, today I'm going to be talking about quant trading. Need to get rid of this. And in particular, I'm going to discuss the concept of market making. Okay. But right off the bat, we'll start with something called a order book. Okay. So I see a lot of familiar faces that come to SQT a lot. You might be very good with this from mock trading, but please bear with me because this is going to be an important concept for the rest of this presentation. So this is order book, and assume that we are trading Amazon. Okay, Amazon is the stock we're trading, and I've asked 6 people in this room to give me their quotes. Okay, so a quote is also known as a passive order. And if we were to look at this quote, so first assume that all of these rows are individual people and individual quotes. So if you look at this quote, this is somebody bidding for 15 units at a price of 80, right? So what that means is this person is willing to buy at a price of 80 for 15 units. Okay, so this is a passive order. This is a quote. Okay, and if I want to hit that quote, so if I want to trade against the person, I can sell to them at 80, right? Because they're willing to buy. Okay, so if I hit this quote, I'm placing an aggressive order, as you can see here, and I will be selling the 15 units to this bidder at a price of 80. Okay, does that make sense so far? Okay, so all of these quotes are passive orders and anybody can hit them. Assume that for now. Okay, so I don't need the 15 units every time, right? I can also hit it for like 10 units, 5 units, whatever I want. And also I can also buy this for like 20 units, right? That just means only 15 of the 20 will be filled, right? And this whole order book would be managed by the exchange in most cases. So let's assume in this very simple example, the exchange is SQT. So it's me. Let's say it's me running this order book. And yeah, the exchange will be looking after everybody participating. Okay. So very quickly, can somebody tell me what this row means? 120 and 10. So try to put this in the same way that I have this here, right? I like to buy 15 units at a price of 80. What does 120 and 10 mean?
Sell 10 units. 100.
Yep, good, exactly. And this is only a quote, right? So before anybody actually hits it, before anybody actually trades with you, nothing happens, right? So you don't spend any money, you don't have to give any stocks. But once the trade happens, if I were to sell 80 to this guy at 15 units, I would have to give this guy 15 units and I will receive 80 times 15 in terms of like cash flow, right? In exchange. Okay. So does that make sense to everyone? Okay. So this is an order book. The bid stands for buy and the ask stands for to sell, right? And this is also known as offer. Ask, offer, same thing. So now we're going to look at some discussion questions about this order book. Okay. So right off the bat, why are the prices of bids lower than asks? Sorry. So if you look at the order book on the left, right, you see that all the bids are below the asks, right? There's no bids up here and there's no ask down there, right? So can anybody tell me why they think the prices of bids are lower than asks? Yep. Yeah, you want to buy a little so high? That's correct. Yep, good. So the 2 answers where you want to buy a little so high, and if the price were to be higher, the trades will happen already. Okay. So I'm going to talk about these concepts a bit later on. Now, why do the quantities of quotes decrease as we approach the middle price? So notice how, assume that these are individual people, right? There's somebody willing to buy at a price of 70 for 30 units, but at a price of 80, someone else only wants to buy for 15. Okay. So you can see that the quantities are decreasing as we approach the price in the middle, right? Where the bids and the asks meet. So intuitively, can somebody explain to me why that might happen? So on like a psychological standpoint, why would you want to bid a bit less as the prices hit the middle? Okay, anyone? So does everybody get the question, right? As you go towards the middle, you see that the quantities slowly decrease, right? Why is that? Tom, what do you think?
Well, I think in position the true value and then value, so it makes myself make this edge.
Okay, so Tom used a few buzzwords there. I will talk about those words in the next slide, don't worry. But his answer is that as you get closer to the middle value, you have less edge, okay? So let's think about his answer and then we'll talk about it in the next slide. Dell online asked a question, what is ask quantity? So ask quantity on the right, this means, for example, if you take 25, that's saying that, take this one, I would like to sell at a price of 130 for a maximum of 25 units, right? So the quantity is how many units you want to do it for, and the price is the price of trading at, right? Okay, let me know if that answers your question, Dale. Okay, no worries. So would we consider this order book liquid? Okay, so don't worry if you don't know what that liquid means, but does anybody want to have a go? Would you consider this book liquid? You might have heard of the term liquidity, right? See if you can think about plausible definition. Would you consider it liquid? Anyone? All right, I'm gonna pick random people. Patty, is this liquid? Just yes or no, that's it. Okay. Okay, so Patty said it's not liquid because the gap is very big, right? Between the buy and sell, which means like the bid price and the bid ask and the best ask price, there's a pretty big gap. Okay. So again, we're going to talk about this later. What is the trading price of Amazon? So if you were to look at this book and if you were to give Amazon a value, what would be a value that you can give? Okay. So let's say you have to write something on this order book. What is it trading at? Okay. Yep. 100. Yep. So how'd you get 100? Like how'd you get 100? Yep. So I think you took the average between the best bid and the best ask, right? Okay. So we're going to touch more on this later, but that is a correct answer. So before I show you the answers that I wrote, I'm going to first give you some key vocabularies that's going to be pretty relevant throughout the workshop. Okay. So the most important ones probably scalping and arbitrage. So these two terms are commonly misinterpreted to be the same, but they're actually not. Okay. So scalping is the act of buying low and selling high for riskless profit or for guaranteed profits once you achieve those trades. Okay. So I'll give you a very simple and realistic example of scalping. So this is Tom, right? Tom is a proud member of our education portfolio. It's very valuable to us. And let's say that Tom really loves Taylor Swift. So he listens to Taylor Swift every day, goes through all of her concerts, really loves her, thinks about her every day. And Taylor Swift has a concert coming up. So Tom would buy a ticket for, let's say, $100 early release, right? And the concert's 1 week away. So he bought the ticket for $100, and it said that the night before Tom catches COVID, and he can no longer make it to the concert. So he sells the ticket on the marketplace for $1,000, right? Because the tickets usually go up in price to buy a lot, Taylor Swift. Okay. So by doing that, Tom has scalped $900, right? He bought it for $100, sold it for $1,000, right? And no matter how much the price of Taylor Swift tickets fluctuate between that night and his concert, his 900 is guaranteed, right? So he's not losing that 900. Does that make sense to everyone? Right. So Tom has scalped by doing that. Okay. Now, arbitrage, the key word for arbitrage, as I've highlighted, is simultaneously. Okay. So it's also buying low and selling high, but you have to do it at the same time because this is truly riskless. Okay. So let's say we have Yavana here, which is another member of our education portfolio. Yavana doesn't like Taylor Swift. And let's say she gets a ticket for free from her friends as a gift, and she doesn't like it, right? She wants to sell it. And let's say Yavana asks me, do you want to buy the ticket for $100? Okay. So she's offering me the ticket for $100, right? It's just like the things on the right. She's offering it to me. So assume that's like 101, right? 1 unit of a ticket. And at the same time, there's another concert coming up, and Tom didn't make the last concert, right? He's got mad FOMO, wants to go really bad. And he asked me, George, do you want to sell a ticket to me for $2,000? Okay. So what's happening here is that Yavana is offering me a ticket for $2,000, sorry, for 100, and Tom is bidding for 2,000, right? Okay. And what I can do as a middleman is I can buy from Yavana for 100, and right away I can sell it to Tom for 2,000, right? And that is what's called arbitrage. So I'm doing it at the same time, and in doing so, the 1900 is secured like right away, right? Like 1 second, if I just message them at the same time, I'll get the profits. Okay, does that make sense? Guys in the back, you can sit in the front if you want, if you can't really hear. We got 4 seats here. There's more seats on the side. Okay. So does everybody get those examples, right? So the main difference is that arbitrage is simultaneous. And yeah, I'll just keep going with the terms. So liquidity, like liquidity was in the last question, right? Do we consider this order book liquid? Liquidity, there's 2 ways to think about it. Number one, you can think of it as the volume of trades in the market, okay? So by quantity or the potential volume. And number 2, you can think of it as the ease of conversion between assets and cash, okay? Without affecting the price. So this one might be a bit harder to understand, but like if you go to the book, right? There probably wouldn't be many trades happening in this book because there's a pretty big gap between the bid and ask, right? So like you said, the price, let's say the price is at 100, right? Everybody buying would essentially be buying at 120, right? Which is 20 units above the price. And then vice versa for sales, right? So you're not really getting the best deal when you're making these trades, therefore not many trades will happen, okay? And number 2 is that if you want to converse or change your assets to cash in this case, right? Let's say you own 10 units of the stock and you want to change it to cash, right? You can hit this order, you can sell it for 80, but in the process, you're kind of losing some money because of the gap, right? And also there's not much volume. So then the point about, affecting the market price, right? Would come in, right? Because then let's say you sell 20 units, then this thing will be gone, right? Then the market price would kind of move. Okay. So we'll give more examples on liquidity later. Yep. So if there's a bid quantity for 5 here, right? Okay, yep. So can anybody answer me like what would happen if there's a bid quantity for 5 at 120? Yeah, so if somebody's bidding at 120 in this order book, what do you expect to happen? Anyone? Anyone? Yep, there will be a trade, right? Exactly, because there's somebody trying to sell for 10, right? And if you try to buy it at 5 units, me as the exchange, right? Like, so I'm managing this order book, I will complete the trade right away, right? So then that's why you never see quantities on both sides of a market book, of an order book, right? Does that make sense? Yeah, good question. Yep, good. So I think people online also had a good answer. All right, now theoretical value. This is also called theo by trading firms. So this will be the fair price determined by the information that you have. Okay. So everybody in this room might have a different theoretical value, right? Like that's totally possible because if I know about the company better than you, right? I can easily have a different level, right? It could be higher, lower, but there's a lot of opinions in this, right? And this also depends on how much data have you looked at, right? You have an analyst, so there's a bunch of factors affecting this, but this is kind of like how we make our decisions, right? Like you don't want to be buying at a place higher than your theoretical value, right? If I think the ticket is worth, say, 50, I wouldn't be buying it for 100, right? If I'm rational. So we'll come back to this term later. Yeah. All right. So next up, we have edge. This is something that Tom mentioned earlier. So edge will be the difference between the trade price and your theoretical value, right? The trade price and the theo. So let's say that I think that Amazon is worth. Let's say that I think Amazon is worth 200. Okay. So then if I have the ability to buy for 120, I've captured 80 edge essentially, right? Because I think it's worth 200. I bought it for 120, right? So in my head, I'm thinking that this is a great trade, and there's an edge of 80. Makes sense to everyone? And then, if I think it's worth like 60 and I buy for 120, I have an edge of negative 60, right? So clearly indicates that it's not a good trade. So if I think it's 60 and I buy for 120, right? I'm just burning the $60 in between. Okay. And the edge depends on your theo, right? Because it's a very clear equation going on. Okay. All right. The final term is adverse selection. This is one of my favorite terms. So adverse selection basically means that like when other people have more information than you will often be disadvantaged, right? So for example, the people placing the quotes can be adversely selected by the people hitting their quotes, right? So going back to my example, if I think this Amazon price is worth, this Amazon stock is worth 200, right? I can buy it for 120 and get the $80 edge, right? So then the person selling it for 120 is being adversely selected, right? So the whole point is that I will only make a trade with them if I think my trade is beneficial for myself, right? So every time you get traded, every time your passive order gets hit, you might think, okay, somebody has a different opinion than me, and they're very likely to be correct, right? So this is something that you often have to think about as you trade, because, people wouldn't be trading with you unless they think they're making money, right? So this is one of the risks of, placing quotes in an order book, because when trades happen, you might be at a disadvantage, right? Does that make sense? Average selection, okay. So I think we had a question here. All good, okay. So any questions on the definitions? All right, amazing. So let's go back to the questions, and here are my answers, okay? So why are the prices of bids lower than asks? And the very clear answer is that if there were bids up here, there will be arbitrage opportunities, right? So like, let's say somebody can bid for 125 for a price of 125, and the exchange doesn't do anything. I can come in and I can buy this, I can hit this ask for 120, hit the bid for 125, and I've pretty much committed arbitrage, right? I bought it for 120, I sold it for 125. So the key kind of assumptions here is that, like in a regular market, when everybody's rational, there will never be arbitrage opportunities. And we call that, there's never free lunch in the marketplace, right? Because number one, people aren't dumb enough to bid at 125, right? When there's this. And number two, even if that were to happen, someone else would have gone there before you, right? Because the marketplace is huge, you're at stock market for people around the world, and there's too many people, trading at the same time, right? So there's very hard for one person to just, get the arbitrage opportunity. Does that make sense? Right? And as an exchange, I wouldn't allow this to happen, right? Because if I let somebody bid at 125, I am doing a disfavor to the person asking at 120, right? Because they've placed an order on my exchange, and somebody's clearly interested in buying, right? Why not I sell to them? So as an exchange, they will be kind of facilitating these orders, right? So the quantities of quotes decrease as we go up, as you can see, it's because there's less edge, right? So this person is willing to buy 70. If they think the value is 100, they're making $30 of edge, right? 30 units, right? Whereas this person is only making 20, right? So as you go up, your edge decreases, and you're more exposed to adverse selection, right? Because then, you're making less money each trade if you get traded with, right? So then you're more likely to be adversely selected in a way, right? So this person, even if somebody trades with them, right? It'll be pretty hard for someone to think that 70 is a good price to sell to, right? Assuming that everybody's kind of rational here. So they wouldn't be as worried, therefore they want to put in more volumes, right? Because then if somebody trades with them, they get to trade more, basically, right? Whereas the people in the middle would be a bit more conservative, knowing that if they put in a quantity of 100 here and they get all 100 traded, right? They pretty much know that they're screwed because someone has a pretty strong opinion against them, and they're probably more likely to be right. Yeah. Does that make sense so far? Okay. People online think you're good. All right. Will we consider this order book liquid? Because unlikely that there will be trades, right? Because the price, let's say the middle price is 100. That's what everybody thinks, right? It's unlikely for somebody to buy at 120, right? Unless they think the price is very high up, but then unlikely, right? With something like Amazon, when you can just determine a price in a way, right? And also, if I have $1,200, right, and I turn it into my stock and I want to buy this stock, I can buy 10 units, right? But then as soon as I buy it, my 10 units, according to this order book, becomes worth sort of 100, right? Do we kind of get what I mean? So if I hit this ask, now I now have 10 units, I spent 1,200, but then my 10 units, if I were to sell it, I can only sell it for 80. So then immediately my portfolio's value kind of went down, right? By making that trade. Assuming that, that's all the orders we have, okay? Finally, the trading price of Amazon. So 100 would be one way to look at it, but there's many different ways to interpret this, right? So this is a very ambiguous question because, you could say the middle price is right, but then you could say, oh, there's 15 units here, right? So why don't we do a volume weighted average, right? Where we multiply these guys, take the average, right? So there's many different ways to look at the trading price, but one way to think of it as is as the average price. Okay, so that's one of the ways. Okay. Any questions so far? Okay, cool. So now we're going to introduce a market maker. Okay, so this is the core reason why you don't see this in the real world, right? Because this is never like nobody's ever trading here. Everybody's sad, right? You can't really buy anything, you can't really sell anything. Exchange doesn't have any trades, right? Not good. So a market maker is somebody that provides liquidity to the market, right? So remember the definition for liquidity is the volume of trades being done and also the ease of buying and selling, right? So a market maker might come in and say, okay, there's a pretty big bid-ask spread, right? So the best bid and the best ask is a pretty big spread. It's like 40, right? It's like 40% of the value pretty much, right? So it's very big. And they might come in and say, I'm willing to sell for 110 and buy for 90, right? And they might do it at a huge volume, okay? And the key rationale for market makers is that, let's say that both of these orders get filled completely, right? So somebody fills that, somebody fills that. They essentially make, the difference, which is 20 times 200, right? So for every pair of these trades, they'll make 20. And this will be scalping, not arbitrage, scalping, right? So by they're buying those selling high, but then they're still at risk if they put these orders, right? So can anybody explain to me why this is not arbitrage? Say, like, if this happens, why is it not arbitrage? So going back to definition, right? Arbitrage means simultaneously buying and selling, right? If this happens to a market maker, if somebody buys 200 units and sells 200 units, why is it scalping but not arbitrage? Yep.
Yeah, because of liquidity, so it's not guaranteed.
Yep, correct. It's not guaranteed. Why is it not guaranteed?
Because like securities are perfectly liquid, so if you want to sell something, someone has to be willing to buy it.
That's true. Yep, that's correct. Yep. So good answer. Because it is totally possible that somebody might just buy the 200 units and not sell, right? And then they might think, oh, maybe my theoretical value is wrong, right? Maybe I sold for 110 and that's too low, right? So they could lose money from it. Does that make sense? So it's totally possible that the market maker could sell 200 units, be happy for a bit, and then the price, like, say, goes up to like 200, and then they're kind of screwed, right? So they're not completely doing this at a risk-free way. Does that make sense? So this will be scalping because they bought low and sold high, but they still had to go through the risk. So what the market makers would do, so the firms that sponsor us, they would use quantitative models, right? To first arrive at the theoretical value, right? So they might think that this is worth, say, like 100 here. And that will be from like historical data, looking at like correlated stocks, looking at the market as a whole, macro environment, right? And then they'll be making these quotes using algorithms, right? So there'll be computers constantly making these quotes up and down just to keep the liquidity, right? And that is because they're always there. So if you're a market maker, if you're kind of operating at an exchange, right, you have a deal with the exchange. So the exchange will allow you to run your business, right, by making these huge trades. But in exchange, you have to be maintaining your liquidity, which means you have to always be having those trades up, right? And an easy way to do that is to use these algorithms. Okay, so I'm going to talk more about these later. Okay, but the relationship between the exchange, let's say me, and some market maker that came in, is that the market maker will receive these scalping opportunities, right? Like we did here, they make 4,000 risk-free. So these opportunities are clearly up for grabs, looking at the previous order book, right? And in exchange, they would also receive cheaper transaction fees, right? So every trade you make on exchange, the exchange takes a little bit of money from me, right? That's how they operate. And if you're a market maker, you might get better fees, right? So better fees means more profit in a way, right? Less cost, more profit. And obviously they're providing the liquidity for the exchange. Okay, so that's like the key relationship between them. Does that make sense, everyone? Okay, so am I good to move on? I think everybody's pretty happy. Nice. Cool. So let's talk about some other stakeholders of this marketplace, right? So this is an order book for Amazon. And I think that, well, the top three are main stakeholders. The bottom one isn't really, but I'll talk about it later. So number one, we have other market participants, right? So if you want to trade on this marketplace, if say you want to buy, instead of having to buy for the price of 120 at a unit of 10, now you have the opportunity to buy for 110 at an even larger volume, right? So this means more liquidity for yourself as well, right? You're able to buy for less and sell for more. at larger quantities, right? So it's easier for you to convert your assets to cash and vice versa because of these orders, right? Because of these quotes. So market participants should be pretty happy about this. The exchange, like I said before, right? The market will be more liquid, right? There'll be, since market participants are happier, getting better prices, more likely that they would trade, right? And then more trades happen, the more money for the exchange, because every trade means transaction fees, right? And they want as many trades as possible as the exchange. This also means that the market is more transparent, right? I don't think I talked about it here, but like it's easier to figure out the correct price of Amazon given this market, right? Because of the trades happening. Okay. If you're a stakeholder of Amazon, so if you're a major shareholder, or if you're like the company, the CEO, I don't know. Very likely because of supply and demand, right? Amazon will be trading at a fair price relative to before, right? So because there's more opportunities to be trading to be happening, if there's more people wanting to buy, the price will go up, and if there's more people wanting to sell, the price will go down, right? So when you combine these forces, it will be trading at a better price. Okay, so, and finally, university students like ourselves and graduates, right? These trading companies, these market makers will be opening up positions like traders. They will be executing the strategies. Researchers will be building the models that arrive at the theoretical values, and developers will be coding the infrastructure that actually performs these strategies. Okay, so there's more jobs for talented STEM students. Okay, like yourselves. Cool. All right, so now I'm going to introduce a simple market making strategy. Okay, so let's say that one of the very talented quant researchers, okay, came up with a theoretical value of 95. So they looked at some data, they performed some analysis, and they said, we think the price is 95 based on Amazon's track record or whatever, right? Looked at the financial models. I don't know. Right? You can tell me more. So 95 is fair value. And they will be quoting with an offset of 10, right? So as you can see, the offset of 10 means that they'll be bidding at 10 units lower than 95 and asking at more, right? So you see, that's what they're doing. So instead of doing that, right, they're kind of more reflecting their theoretical value. Does that make sense, everyone? Right? So they're working around what they think the value is, okay? And they will be trying to maintain a constant quantity of 300 on both sides, right? So using the computer algorithms by the developers, they will be trying to make this happen at all times. Probably because the exchange tells them to, right? But this is also good for them. Okay, so that's the prices we arrive at. And yeah, all three variables, right? The X, so our theoretical value, the offset, which is 10, and the quantity to trade, right? There's plenty of factors that can influence that, right? So just talk about all of them, right? The historical prices. If the prices are very volatile, right? You might be going for a slightly larger offset, right? Because you're more at risk of adverse selection. Does that make sense, everyone? Right? So we're gonna do more, discussion on this later, but the data itself can also affect how the X is derived, right? So if historically the price is very high, you might go for a higher X, right? Given your models. Now, liquidity, level of competition, right? The more people competing, the more people trading in this market, means that the prices are probably going to be shrinking, right? Or the bid-ask spread is going to shrink, right? Because that means more competition. And we still have like a pretty big spread here, right? 20% of say 100, right? So then you might change your offset to be maybe something like 5, right? The requirements by the exchange would affect the quantity, right? Maybe it wouldn't be 300. Maybe if the exchange is very strict, it'll be something like 1,000, right? I don't know. Our risk tolerance, right? So if you're very risk adverse, right? So if you don't want that much risk, would you go for a higher offset or a lower offset? Anyone? So if you don't like risk and you're trying to, sorry?
Lower offset.
Lower offset? Why is that?
So we can,
So if you don't like risk, right? You don't want to be risky. So you rather give up some profit for a more steady operation, right? So do you think it's a lower offset?
Yeah.
Why is that? So imagine, let's say we have an offset of let's just use a very extreme example. Let's say we have an offset of 1. So they're going to be bidding at 94 and asking at 96, right? Would you say that's riskier or less risky?
Less risky.
Okay. Does anyone have any other opinions?
If you increase the offset, you basically, like, if you increase the offset and the best possible trade happen, right, you have a very high chance of making that money.
That's true. Yep. So more offset means more profit, right? In terms of like, so profit will be volume times edge, right? So you get more edge, but maybe less volume, right? That makes sense?
Yeah.
So do we have any other answers? So he thinks that the offset should be lower. What do we all think? So I don't like risk. I want, every time a trade happens, I want to be very happy about it, right? So if you remember from before, when I compared these two people, right? Who is happier when a trade happens? I mean, like in terms of risk, right? So like this guy trades, if somebody sells to this guy for 80 versus somebody sells to this guy for 70, like who's going to be more confident about the fact that they made a good trade? What do we think? 80 or 70? 70, right? Why is that? Yep, good. So because they're buying for lower and they're buying for a larger edge, right? And that's effectively like a larger offset, right? Okay, so what happens is when you increase your offset, let's say for like, so like a lot, let's say we increase to like 30, bidding at 365, you're selling at 125. Nobody's really going to make trades with you, right? Because it's like you're not doing it at a very competitive price, right? You're like you can't really see yourself on the order book. But when a trade does happen, you wouldn't be that scared of it being bad, right? Like it's probably some idiot clicking the wrong button, right? Like think of the spread being like 90, right? Somebody sells to you at 5, they're probably like not doing the right thing, It's Amazon, right? So if you're risk averse, if you don't like risk, you want to be increasing the offset, right? And if you want to maximize profits, you might look to decrease it depending on the competition. Okay, does that make sense, everyone? Okay. And yeah, finally, our edge, similar, right? If you think that our theoretical value is very accurate, so if you think this is accurate, you're very confident in it, right? Would you be more likely to increase or decrease the offsets? So we're very confident that the price should be trading at 95. Would you increase or decrease it? Anyone here? So the question is, if we're really confident in this 95 theoretical value that we arrived at, would we be increasing or decreasing our offsets that we're bidding and offering it? Increase? Why is that? Decrease, yep. So that's correct. Why would you want to decrease? Can you think of an explanation? Okay, give you some time. Yep. That could be correct, but I don't think you're thinking about it the right way. Okay. So, correct. You can push more volume, so you can maximize your profits, right? Because you're confident about the things you're buying at, and selling at. I think we'll take that answer for now, right? You can push for more profits. So let's see. So if you're really confident about this, right? So let's say you're not very confident about it. So let's use a counter example, right? Let's say you're not very confident about your 95 and you do the opposite. You decide to go for a very, very low offset. You want to bid at 94 and offer at 96, right? Could it be very possible that the actual price is at like 120, right? If we're not confident, it could, right? So then us offering at 96 is a very, very bad trade, right? Like we can be easily picked on, average selection, yeah? So the counterexample is that if we're not confident and we go for a very small offset, we'll just get picked off, right? By informed people trading with us, right? People who know the true value, And vice versa, if we're very confident, then we might, and then we go for like a 94, 96 bid ask spread, right? We know that every time a trade happens, we're correct because we're very confident in 95, right? So if somebody sells to us at 94, we made $1, vice versa. If we buy, we make $1, right? In edge. Does it make sense, everyone? So if we're confident, we can decrease our offsets, okay? But for now, we'll just stick to 10. So now we're going to continue the strategy. Suppose that somebody trades with us at this price, okay? So they hit our ask, which means they bought from us, okay? They bought from us for 250 units at a price of 105, right? So since they bought from us, we sold and we now have a short position. So you might have heard of long and short in terms of like your positions, right? It means long means you want the price to go up, which could be bought, and short means you want it to go down, right? So selling will give us a short position. And the position basically means that we're currently down negative, we're currently down 250 units, right, of the stock. So we really want the price to go down, right? We're shorting it. Does that make sense? So an easy way to think about it is that if the sign of your position is negative, you want the thing to go negative, right? You want it to go down, and vice versa, okay? So we have to provide 250 shares of Amazon, and we will receive this amount in cash from the buyer, okay? We all get that? So according to our field, right, according to our X, we have made that much, right? Because we've sold 250 units at 105, and assuming that we're very confident that it's 95, we've made this in a very theoretical scenario, right? Like if everything goes well, that's how much we make, right? However, this is called unrealized. So why do we think this is called unrealized? Does anybody have any ideas? Why do we call this unrealized profits? Okay, so we did make profit, theoretically, yep. Yep, correct. So this amount is not in our bank yet, right? We might have made the trade, might have been good for us theoretically, but something can always go wrong, right? So this amount, like, we made that money in theory, but we don't have it yet. So it's unrealized. But we still call it profits, right? Because according to our X, right, we've made profits. We've made a good trade. So given this short position, right, like I said before, if the stock price increases, we'll lose a lot of money, right? Because we sold at a price that is lower than the, let's say, increase to 200, right? We're going to be pretty unhappy because we can sell for a higher price than it, right? And if it decreases, we're very happy, right? Because let's say the stock goes to 50, we sold at 200 or 105, right? We are very happy, okay? So that's what a short position entails. However, right, this might all sound very fun, you know, making the unrealized profits. We have to remember that our rationale as a market maker is to scalp, right, from the previous slides. So our goal is to, you know, make approximately equal number of trades, right, in both directions so that we make the difference, right? This is our goal. That's what we do as a market maker, right? We're not that interested in taking these gambles with the stock price. Obviously, we could make money, but that's not our business, you know, operation, right? You get that? So knowing this, we might want to add a skew to our offsets. So we have a question here. How to trade ICT? Anyone know what ICT is? So I don't know. I don't understand your question. Sorry, I don't understand. Okay. So adding a skew of +5 means that we might want to move our bid and ask up, right? Okay. So I'll explain this on the next slide. But the offset will basically increase both our bid price and our ask price. Okay. And this is one of the strategies that we can implement. So trade Forex. I'll talk about Forex and stuff later. Okay. This is just very simple Amazon stock. So due to our skew, as you can see, both our prices have moved up by 5 units, right? That's called a skew. Okay. So yeah, but despite our skew, we still have the same offset, right? Our offset is still 10. Yeah. So think of skew as like this guy moving up 5, right? So because of this, now we are discouraging people to hit our ask, right? Because if somebody were to buy from us, they're now buying at a higher price, right? 5 units higher. Okay. And if somebody wants to sell to us, they now get a better price to sell, right? Instead of receiving 85, they now receive 90. So we're making it better, or we're encouraging them to sell to us, and we're discouraging them to buy from us. Does it make sense? So this is also called retreat, right? Skew, like I said before, the +5 is also called retreat because we're moving towards the person that traded with us, right? So in the previous example, somebody bought from us at 105, right? That means that they think the price is higher, right? So therefore, we're gonna move towards them a little bit, right? Just to kind of reduce our risk. Okay, and by the way, this is only a very simple, very trivial strategy. Okay, this might not be what everybody does, but we're trying to use this to learn, right? So, why are we trying to discourage people to hit or ask, right? Can somebody explain? So why do we want to do this? think everybody gets what we're doing, but why do we want to do as a market maker? And I think I have it on the slide as well, but anyone brave? Yes, correct. So like we said, as a market maker, we want to keep this guy zero if possible, right? So we're making the guaranteed profits, right? We're scalping. So then, if we keep it as it is, right? Somebody might just keep buying from us, and then we're going to accumulate a huge position, and then if the stock goes up, we're losing all of our money, right? So we don't want that. So then, therefore, we want to make it easier for people to sell to us, right? So the best case scenario, given our position, given everything, is that somebody sells to us at 90, somebody hits our bid for 250 units exactly, right? So then when that happens, we sold 250, we bought 250, right? Our thing goes to zero. And previously we sold for 105 times 250, right? So we made that much money from selling. And then to buy, right? If somebody hits our bid, we pay that much, and you see that we've made that much by scalping, right? And this is the best case scenario. And this is what we want to happen because we're trying to adjust our skew. Does that make sense, everyone? Right, and now the profits realized, right? Now, no matter how much the stock changes, right? If our position is zero, we have made this money, right? It's in our bank, So we are now officially risk-free. Like we don't care about the price anymore. We still do, but like given these trades, right? We're now out of it, Really understanding me? Okay. Can somebody give me a worst case scenario given this? So best case is somebody hits our bid. What do you think the worst case might be? What's the worst case scenario as a market maker here? Anyone? Yep. Yeah, but what's the worst case scenario? Like what's something that someone can do to make our position really bad? Like yep. If the price goes up, yes, but notice how we still have quotes, right? So what's something that someone can do to us? Yep. That's right. So if somebody buys all of this, right? Will now be minus 550, right? Let's say the person is does insider trading, they just know that Amazon's going to go up because of some deal, right? Some M&A, I don't know. And the price shoots up to 1,000, and then we lose all of our money, right? Because we're short that many units, and the price goes up, we have to find a way to get those units back, right? We have to pay, the units back to whoever okay, shorting is very complicated. You have to borrow the stocks and sell, right? But essentially, this always has to go back to zero, right? At the end of the day. So if it goes up to 1,000, we'll lose a bunch of money, right? Cool. Good to move on. All right, let me see how we're doing time. Cool. All right, so here's going to be a more realistic look at the order book now. Okay, so let's compare this to the one before, right? So we notice that there's way more volume in the bid and ask, right? And then we've kind of taken a lot of people's orders and we put them together, right? So one assumption in the previous one is that these are going to be individual people, right? Nobody's bidding or asking at the same price, just for simplicity's sake, just to make it trivial. But now, given a more realistic market, people can do whatever they want, right? They can bid and ask at many different prices at the same time. So then we're just going to add the quantities together, right? And on the side here, we have our own individual quantities. So we're a market maker. We're very happy to take trades of huge volumes. So you see our things are very big. And for some price levels, we're doing half, right? Half of the total quantity. So we might be joined by many other market makers appointed by the exchange, right? Because if there's only one market maker, they can just take off all the profits, right? From scalping, right? It's like competition, That'll be like a monopoly in the market, if you will, right? So in exchanges, to really maximize liquidity and to make things fair, they might have multiple market makers just to keep everybody honest, right? And the tick size here is 1, okay? So you see that tick size basically means the minimum difference between prices, right? So this person is bidding at 100, the next one you can go to is 101, right? And somebody tell me a potential benefit of implementing tick sizes. So this is implemented by the exchange, right? I've made this rule. What's a potential benefit for everyone? Yep. Liquidity. Not so much. It's not really the reason, but good try. So why do we want to have tick sizes like that, right? Okay, anyone? Yep. more competitive prices could be true, but no.
Arbitrarily competitive.
Yes, correct. So can you give me one example of something bad or something annoying happening if there's no tick size requirement?
Like we just go to like 6 steps.
Good, yep. So one thing that you need to know about trades is that these passive orders, right? If I were to hit this guy at 101, if I were to buy from them, they'll be executed at a price time priority, right? So the better price will get it first. So this guy will get the trades quicker than that guy, right? Or like not, these are many people, but like this guy would be getting the trades first because they're asking at a lower price, right? So they will be prioritized, okay? And in the event that there's multiple people, then it's going to be whoever that, put this ask here first is going to get their trades executed first. And, if you're trading, right, you kind of want your things executed quickly, right? You don't want to wait. That means more risk for adverse selection, right? We all agree? So one thing that Name said about the arbitrarily competitive prices is that, since there's a time requirement, if I were to, let's say I want to bid and I want to beat these guys, right? If I bid right now at 100, I'm probably going to get the trades last because there's 10,000 units before me, right? We all get that? It's because of the price time priority. So this is where time comes in, right? What if what if Name realizes it and he could bid at like 100.000001 for 10,000 units, right? And then that's kind of a way of cheating, right? Like, do we all agree? Because then we've kind of, okay, we've bid for like, a hundredth of a cent higher than this guy, but in reality, that's like not even $1, right? But then now we get priority over everyone. So to minimize the risk of that happening, the exchange would do tick sizes, right? So that everybody, like the prices are already competitive enough, right? So then there's no silly stuff going on, okay? So if you remember from before, I said that, let's go back to multiple slides. So assuming that these are all individual people, as you go up from here and go down from here towards the middle price, there's less quantity, right? Because people are more risk averse, right? They're more scared of getting adversely selected, right? There's less edge. So why do we think that in this case, the total quantity goes up as we hit the middle point? Okay, so do you see the difference how here we are decreasing, but then the total one goes up, right? And again, this is only an imaginary scenario, but it's going to be kind of true in the real world, right? So why are all the quantities like near these prices? Anyone? Everybody's welcome to answer. Not be shy. People on Zoom as well, you can answer this. So say the question again. Why is it that the total quantities increase as we meet in the middle between the bid and the ask? Yep. Sorry? Okay, so her answer is that more people think that the real price, so when you say real, that means like the theoretical price for, like say for everyone, right, is in the middle, okay? That's, well, if you think it's here, right, like let's say you think the price is like 100.5, right? You're still pretty happy to buy at like 50, right? You know what I mean? It's just that nobody would trade with you, right? Okay, so can anyone give me a different answer? Why is it that quantities go up as we hit the middle?
More likely to get trades.
Yep, good. So more likely you get trades, right? Because of this price time priority, right? If I trade at 50, if I bid at 50, no one's going to really trade with me at all, right? So then it's kind of pointless. So then that means there's more liquidity around the middle prices, around the competitive prices, right? Like this is competitive relative to that, right? Because it's $3, they're trying to pay $3 more than that, right? It's like an auction, right? You want to sell your things to the highest bidder, right? So knowing that, everybody would be trying to place orders here, right? So that they're more likely to get the trades. Okay. But as a market maker, we're still pretty happy to do stuff here just so that, in case somebody say fat fingers, misclicks, does happen a lot, we'll make a lot of money, right? Or if somebody's just really stupid, right? Okay. Any questions? Yep. And if you actually go on like a broker, like PumpSeg, this might be what it looks like, but then there will be more decimal places. The tick size is usually not one. It'll be like maybe, I think down to the cent usually, right? So I think that will make sense to everyone, right? Cool. Now I'm going to discuss another way of trading. So far, given like with all this order book stuff, right? This is called trading on the exchange. So like I said, there's a body managing all of this, just to make sure there's no dodgy stuff, right? For example, the tick sizes with the price time priority, there's infrastructure set up. Another way to trade is to trade directly, and this is also called OTC, over the counter, and it's the alternative of trading on the exchange, right? So the case here is that suppose somebody wants to make a very high volume trade. So somebody wants to buy 20,000 units at once, right? Given this order book, like these are already pretty big quantities, but then they might have to cross a lot of prices, right? So crossing prices means, you're making some trades here, but then you're going to a worse price, right? So it's kind of like not the best scenario for them, right? Because they end up buying some at 103, which means less edge, right? Like negative edge at that point, right? So given like the demand for these trades, because there are very big financial institutions, trading, right? You can trade with people directly. So then if somebody's down to sell 20,000 units, they might just sell to the person directly, right? One-on-one, without going through the exchange, right? So then, the person selling, they might just get the price of like, say, 101.5, right? Something fair, something in the middle. Does it make sense? And these trades actually end up being I think when the stock market first got introduced, these were actually the most popular trades happening, right? Because everybody was making huge trades. But then more and more people like ourselves, right? We gain access to trading. So then the exchange is becoming like bigger in volume. But then, this is always going to be big, right? And why are they always going to be big? Because, this person buying, right? They'll be able to get better prices. So they're more happy to do a trade like that privately over the counter. This is going to be easier for whoever is managing like the trade, right? It's like the exchange of asset for cash, right? So there'll be cheaper transaction fees, right? So the exchange, like let's say this happened, it's gonna be like hundreds of people, selling or asking, right? So then if this person buys all of them, the exchange has to manually, or not manually, but like they still have to, distribute everything to each one of them, right? But if there's only two people making the trade, if there's only two parties, then it's very easier. It's much easier to facilitate, right? Less resources used to make that trade happen. And finally, there will be more flexibility. We'll talk about this later, but the idea is that if you're trading, one-on-one, you can set up a lot of like a lot of different terms, right? With different, say, contracts, different conditions, right? And yeah, we'll talk about that later in one of the asset classes. Does that make sense to everyone? Over the counter, okay? Cool. And we can still market make over the counter, right? We can still sell to this person for 20,000 units at a price of 101 and buy from someone for like 20,000 units at a price of 99, right? Totally possible. So like, market makers do, participate in these trades a lot, right? So cool. So now we're going to discuss types of edge as a market maker, right? Remember before I said edge will be the difference between your theoretical value and the prices to trade at. We also use edge in trading as a term for advantage, right? So if you think you're better at someone in whatever they do, you have edge over them, right? And as long as you keep doing that activity, you're going to be profiting, right? So edge means advantage. So we have three main things here. Kind of follows from what I talked about before. Number one is pricing, right? And that is estimating our theoretical value itself, right? So you can probably see very easily that if you have a better theoretical value that's more close to the real value, right? It's more likely that you make money, right? You're going to be making better, you're going to be making more good trades and less bad trades, right? So that'll be coming from like a lot of data analysis using AI, artificial intelligence, a lot of good mathematical models, right? And this will be the job of quantitative researchers, okay? And besides, just the nerdy stuff, you also have to know the asset itself, right? Like Amazon and how the market dynamics work, right? So like if you have to understand the tech environment, right? You have to understand, say, if there's a regulation coming out, right? How does that affect Amazon, right? So there's a bunch of factors in play, but estimating the X is very important, right? And this could be an edge for anybody in the market, right? Because this ensures that you're only making good trades, essentially, right? Number two is about the bid-ask spread, right? So if we have an offset of 10, what is our bid-ask spread? So let's go back to the example. I think I didn't use this term that much, but if we have an offset of 10, what is our bid-ask spread? Anyone? 3? Why is it 3? Sorry, who was that? 3? Why is it 3? Sorry, 20. Yep, 20 is correct. Yep, because there's a difference of 20, right? So this kind of tells us, in the best case scenario, right, we can make $20 per pair of trade, right? So one person buys from us, one person sells, we make 20. So that's the spread, So it's kind of like a game of like optimizing everything, right? You want to go for the bigger spread, obviously, so you make the most money, but then you also want to have good volume, right? So it's like two variables at play. So that's kind of what motivates people to be competitive, right? In terms of the pricing, the spreads. So yep. So if you have tighter spreads, it means you're more competitive. It means you get more trades in, right? More volume. And then profit is volume times like edge, right? So then you get more profit. But this also depends on our risk appetite, right? So we talked about this earlier. If you don't like risk, you might be going for a larger spread, right? So less trades overall, but if trades happen, you're good. You also have to be very confident in your pricing model to go for a tight spread, right? We also talked about that. And you also want to have a good relationship with the exchange. So as a market maker, if you give a lot of liquidity, if you're facilitating a lot of trades, right, the exchange will give you better and better deals, right? They'll allow you to keep doing your market making, keep doing your scalping, and they'll give you less transaction fees, right? And if there's less transaction fees, we will require less edge per trade, right? Like if a trade costs us a cent to make and we get 0.5 cents of edge, right? We're not really going to want to make that trade. Whereas if our transaction fee goes to like 0.01, like 0.1 cents, right? We could be making those trades. Does that make sense, everyone? Right. So yeah, sorry. So yeah, then you could go for tighter spreads. And finally, speed is important, right? Like we said, price time algorithm, right? The first one to get there, say going back to the price of 100, right? Would get the bid, right? Be able to buy. So this is a concept called FPGAs, right? So a lot of firms hire these engineers, these hardware engineers to basically make that happen, right? I don't really know how this works, to be honest, but you can search it up if you're curious. If you're studying like electrical engineering, this might be something that you can look for as a career, but it all sounds pretty fun. And also on the software side, right? You want to be writing low-level languages, right? Languages that are closer to the hardware, right? So examples like C++, Java relative to Python, right? Which is very high level, very slow. But then everybody's kind of doing this nowadays, right? So that's why when you apply to some market makers, for example, like Optiver, right? As a developer, you can only do the assessments in C++ or Java. They don't allow you to do it in Python, right? Because they're using efficient algorithms. Okay. Does that make sense for everyone? All right. And the second question is, where is the edge coming from, right? So we discussed a lot of edge, but then where are we actually making the money from, right? If everybody's smart and everybody knows that, then nobody's going to be making any money, right? All the money is going to go to the exchange for doing the trades, right? So the biggest, well, let's call these guys edge givers, right? By volume will be retail flow. So retail flow just stands for like everyone trading, like me and you, right? I think a lot of people here trade, they're all retail flow. If you trade, you're probably retail flow. And the best description for retail flow, like these guys, is that they're individuals who do not have the sufficient capital, right? The sufficient knowledge and the sufficient hardware and software to compete with these big financial institutions, right? Like Morris might think he's very good at trading, but then, he might be overconfident, right? Like, how is he ever going to compete with, like, say, Goldman Sachs, say, Optiver, right? They're very big institutions who pay people a lot of money to trade. And Morris here doesn't have all of that, right?
I think Sig's bigger than Optiver, actually.
Okay, Sig, but Sig is still smarter than you, right? So people like Morris are more prone to making some negative EV trades, right? Like Morris's theoretical value might be very off compared to something derived by like 10 mathematicians, 5 PhD, say finance students, right? Like Morris cannot compete with them. So then when he makes trades, right, it's more likely that his trades are losing money in theory. Does that make sense? And this will be the bulk of the edge for market makers, right? And it's not just Morris, it could be everyone, like myself included, right? I trade ETFs sometimes, right? I understand that, as I trade in this big, say ASX, right? I'm definitely not the smartest person trading, right? So you do have to understand that as you trade. And the retail flow in a lot of the emerging markets, right? The markets becoming more and more liquid, becoming more and more prominent, like India, South Korea, Brazil. That's kind of the main reason for market makers to move into those markets and start operating, right? Because those markets also have less competition. Does that make sense? Right. So if you're able to say, go back to this scenario, right? Like this will be the dream for market makers, being able to do this, right? With a spread of 20, like everybody wants this. So in India, maybe not India, but like in say like some random country like Zimbabwe, right? This might be the case. So You're very happy about that. That's retail flow. Everybody loves retail flow. Next up, we have financial institutions, right? So like hedge funds, banks, asset managers, etc. Right? So these guys will have strong opinions, and I'm going to talk about this later. And they would love to make directional bets, right? And with large quantities. So who's actually providing these large quantities? It will be market makers, right? If I sell to one hedge fund for 100 and then buy from another hedge fund for 80 a month later, right? I'm scalping and the hedge funds get what they want, right? They're making these bets. So these will be discussed in the next slide, I believe. Yeah, perfect. And there will be other market makers that, you know, like I said, every exchange, right? Everything you're trading, there'll be other people competing with you to make things fair. So it's not a monopoly of market makers. This is becoming very relevant in developed markets, right? Like US, Hong Kong, China, right? There are multiple market makers trading the same assets, right? The same securities. So then you want to go back to the last slide and look for things that make you competitive against other market makers, right? Like if you're always faster than someone else, then you're always going to get to the retail flow quicker, right? So you might think that, you know, there's a bunch of institutions, right? Everybody's moving billions if you see on the news, but there's still so much money to be made, right? Like the industry is not very fully saturated just because of how often people trade nowadays. Like anybody can trade, right? So, you know, every exchange has a bunch of stocks. Every stock has a bunch of like different derivatives, right? Like there's so many things to trade, which is why these companies are still getting bigger and bigger. Okay. Any questions on this slide? Yep. Good question. So like how do they work? As in like how do they deliver?
Like the BlackRock S&P 500, now they have to always like buy and sell that.
So BlackRock is a asset manager, right? I don't really know the details of how they facilitate like their own ETF, but like with ETFs, just like with everything else, you can't just be short something in the end, right? You have to be clear. I'm gonna talk more about it later. Maybe the slide will help, but yeah, hopefully that answers it for now. Okay. Excuse me, guys. Gonna go to the next slide. So everything I've said so far in the last hour, right? This might be pretty foreign to you, like market making, like scalping, arbitrage, right? But you've definitely heard of these other financial institutions, right? Like hedge funds, super investment banks, right? Everybody should know about these. And so the whole industry, the whole financial industry is categorized by two sides, buy side and sell side, right? A common misconception is that these guys only buy and these guys are only selling. This is partially true, right? These guys like to buy, but the general idea is that in essence, buy side firms, buy side institutions love to make the directional bets, right? So buy side firm might think, say Apple's going up, they might be very happy to buy for 10,000 units, right? Excuse me, guys. I'm just gonna finish the slides off. Yep. Okay. Whereas the sell side is more happy about doing the scalping, right? Making the money from continuously trading with edge, and hoping to make, you know, guaranteed profits with scalping, right? So they kind of work together a lot because these guys want to buy huge volumes, and these guys will be providing the liquidity, right? They'll be providing the volume. So there's always something to trade with. Okay. So for each of these, I'll give a quick definition and I'll see if anybody recognizes any of the logos here. They're all very big institutions. So starting with this one, hedge fund, who's this? Citadel, yep. So Citadel is one of the biggest hedge funds in the world. Their market making wing, it's called Citadel Securities. They actually sponsor us. But hedge funds basically have a bunch of capital put in from their investors, and they'll make they'll make slightly riskier directional bets, trying to maximize the profits, right? So these hedge funds, they not only buy, they also do a lot of short selling, right? Which is borrowing stock and then selling it to short the stock, thinking it's going to go down. And these guys trade a wide variety of like products, right? A lot of derivatives. And yeah, that's hedge funds. Who's this? Australia Super, right? I think this is the biggest super in Australia. So how it works in Australia is if you work a job, right? 9% of your salary goes to a super, and then when you're 65, you get to have all the money, right? But then between now and 65, the super is going to be investing your money, right? So these guys have a wide range of portfolios, right? They're very diversified, and they buy a bunch of things, and they hope that it's going to go up steadily over time, so that you don't lose all your money due to inflation, right? So all super is one of the biggest ones. What about here? BlackRock. Wrong. Vanguard, yes, correct. So Vanguard is, I believe, the second biggest asset manager in the world. Biggest one is BlackRock. So what asset managers do is very similar to hedge funds, except that they're going to be more risk averse, right? So they're going to be doing less risky bets, and overall they just want to kind of go with the market, right? Whereas hedge funds have to continuously make like trade, right? Like they have to continuously trade, whereas asset managers can just hold something for a long time. But if you want to know more about the difference, you can just Google it. I think there's plenty of resources online. Okay, but all three of these examples, all three of these groups of institutions love to make bets, right? Like they have a lot of information from their analysts, from people studying finance, doing their modeling, right? And they prefer, coming up with theoretical value and then placing as many orders as possible to make money from that, right? From edge. Okay. Now onto the other side. Who's this? Sell side? Not SIG. Not IMC. Anyone? No. Observer. Yes. Good. Thank you. All right. You guys are banned from speaking. So this is Observer. Observer is one of the biggest market makers in the world. This is the Greek letter for delta, right? It's one of the options terminologies, but basically market makers, they're the ones we've been talking about all day today, right? Guys, excuse me. All right, so just very quick shout out to all of our sponsors, right? This event wouldn't happen without them. So here's all of our sponsors. Kuna used to be on here, but you know what happened. And yeah, like I showed, like I said earlier, Citadel Securities, right? This is the Citadel market making division. But our study is sponsored by all the market makers. So when you say quant trading in this context, you're usually gonna work for one of them, right? So this is pretty much everything I've described today, right? Presents, yeah, with continuously buying and selling, right? Not continuous, but like scalping, basically trying to make money from providing liquidity. Okay, who's this? Yeah, Bank of America, Merrill Lynch. It's called BOFA or BAML, but they're one of the biggest investment banks in the world. So investment banks, they provide a wide range of services. Like they do like IPOs, they help banks get out of trouble, right? But something to do that's very famous is called M&A, mergers and acquisitions. So if one company wants to take over another company, they might do this takeover via the investment bank, which pretty much helps facilitate the takeover, right? They'll do like all the due diligence, they'll transfer the funds, all that stuff. I don't really know that much, but this is a very popular destination for finance students, right? And in doing the facilitating, they're essentially on the sell side, right? They're trying to make money, like take the transaction fees for a merger or an acquisition, right? Who's this? Not Combank, close. Not Commonwealth, anyone? Comsec, yes. Maybe it's the same logo, that could be my bad, but this is Commonwealth Securities. So I think they're the number one broker in Australia for ASX, so the Australian Exchange. And a broker, what they do is they'll provide people with the opportunity to buy and sell, right? So if you guys want to buy something right now, you might go to Comsec. And in doing that, Comsec will charge its own transaction fees, right? So, and that's the form of, sort of like market making, but not really. Like they're on the sell side though, right? They're making money from volume. Not like Comsec will never have an opinion on anything, right? They will never go in and buy a lot of things like Vanguard, right? They just want to make money from people trading on their platform. Okay. Cool. So any questions on this slide? Okay. All right, now we're going to talk about something called asset classes. So asset classes would be the securities that these companies actually trade, right? And I'm going to go through the primary asset classes first. So these are usually the underlying, like the most fundamental asset classes being traded, okay? So right off the bat, we have something called equities, which is also known as stocks. These will be shares of ownership in publicly listed companies, right? So in the previous example, if we're buying Amazon, right, you actually be buying for a percentage of its share. It'll be a very, very small number, but you start buying for a share, right? And if you own the share, you kind of own the company in a way, a very small percentage of it. And in exchange, if Amazon or Apple makes money, you can receive something called dividends, right? That's when a company makes money and they want to distribute some of this profits, right? Which makes sense because if you own a percentage of the company, you also own its profits in a way, right? So dividends is something that relates to buying equities, right? And this is highly relevant in trading because these guys get handed out on a regular basis. So let's say like every 6 months, right? And then like let's say you're holding a stock, it'll be very silly of you to sell the stock the night before the dividends are out, right? Because then you miss out on the dividends. So this is something that is always monitored and calculated for. And equities, as you would imagine, is very volatile in the short run because these are individual companies, right? Like if somebody releases their financial reports, if some regulation comes out, right? The stock can move up and down drastically in the short run, like on a day-to-day basis. Okay. Okay, I'll address the question in the comments later. So here are some examples of popular equities being traded. Can anybody name me the four? So who's this? Apple, yep. GameStop, Bed Bath & Beyond. So these are all meme stocks, right? This is what retail flow loves to trade. This one? Alibaba, good. So yeah, these are some popular equities, but there's thousands of them, right? Tens of thousands of them around the world. So yeah, that's what a lot of people trade. Yeah, any questions before I move on? All right, so another one is commodities. So these will be physical goods, often with utility, such as like oil, gold, wheat, corn, anything really, right, can be traded. And they often have low correlation with stock prices, right? Stock prices. So like if Apple goes up, I think people around the world still want to eat corn, right? It wouldn't really affect corn. So these are often tracking inflation, right? Because inflation does represent the cost of living. So if inflation goes up, a lot of these commodities would also go up, right? So here are some common ones, but commodities often aren't traded on their own. I'll explain this later, but they'll be traded in like using derivatives. So here's an example of corn futures, right? I'll talk about futures in a second. Any questions? All right, amazing. Now we're going to talk about fixed income. So these guys are often known as bonds, right? Very popular one is government bonds, but I have a list of things here if you want to have a read. They're called fixed income because they're relatively stable, right? They're very low risk relative to the stocks or to the commodities like gold. And what they do is they will pay you a set rate of interest over a time period, right? So if you buy a government bond, you're going to give the money to the government, and the government's going to guarantee you that you're going to say receive this much in like say 1 year, right? And this will never be risky because the government's very unlikely to go down, right? So you're always getting your money back usually. So it's very risk free. And they'll be paying something called a coupon throughout the time period. It kind of works like dividends, but just know of it as very stable. Now, this is dependent on interest rates and inflations, but mostly interest rates, okay? And the actual set interest will be determined by the interest rates. And this will be set at the beginning of the bond. So if you buy a bond, you're going to agree to the bond's terms, and the terms wouldn't change until the end, okay? So can somebody tell me what they think the correlation is between interest rates and bonds? So like let's say interest rates go up. Do you think bond prices will go up or down?
Inverse.
You're bad for speaking. Anyone? So if interest rates are going up, what's going to happen to bond prices? Okay, so going down. Can anybody explain to me why besides him? Why? So like, why do we think as interest rates go up, the bond prices go down? Sorry? That's right. So in life, there's something called opportunity cost, right? If you do something, you're often missing out on something else, right? So let's say interest rates go up and the bonds have already been distributed, right? So the interest rates aren't changing, right? So let's say the bond is, let's say the terms of the bond is like a 10%, is assuming a 10% interest rate, right? If the interest rate moves up to 20%, why would you buy a bond that gives you 10%, right? You might as well invest your money in a bank or something, right? So as interest rates go up, it's less like attractive to invest in bonds, therefore the prices go down, right? So there's going to be more supply, less demand for bonds, and vice versa, right? If interest rates go down, the 10% bond might look very attractive relative to the interest rates. Okay, so does that make sense? Okay, but all in all, this is very stable relative to everything else we talk about. So yeah, that's why it's called fixed income. All right, foreign exchange. So I think this is the biggest traded security in the world, right? Just because of the trades happening between countries, right? You often have to trade the currencies, right? So this is traded in very high volumes, and you're basically buying and selling foreign currencies, okay? And this is going to be very dependent on the macro environments and also the individual country's interest rates, right? So let's say that we have a country with a very low interest rate and another one with a very high interest rate. So what's something that you can do to profit from this? Any ideas? So there's one country with like, so let's say 0 interest rate, and there's another one with a very high interest rate. What's something that you can do? Okay. But like, what do you invest? You buy bonds. That's kind of correct, yes. But where do you get the money? Convert currency, but where are you converting? Like, how do you get the money in the first place? To work a job, yes, but like, if you were trading, right? How do you get the money? Borrow money from. Yes, good. So something you can do is you can say, let's say we have country A and country B. Country A has low interest rates, country B has high. You can borrow money from country A at a low interest rate, convert it to country B's currency, and then put it in the bank or something, right? Or buy a bond. And then you kind of scalp from the difference in interest rates, right? So that trade is pretty popular, I think, back in the day, but then sometimes it just flips and then you lose all your money, right? So I think that they call it the widowmaker trade, because a lot of traders would do that trade and then they'll lose their jobs, lose their families, and widowmaker, right? So that's something you could do. With currency, some are going to be free floating. I think the USD, right? Free floating just means it's going to be, the price is going to be dependent fully on the supply and demand of USD, of the US dollar. And some are pegged. For example, the Chinese yuan is pegged, right? Like, does anybody know why the Chinese yuan is pegged? Well, first of all, peg means that the price is going to be fixed, right? So it doesn't really react as much to supply and demand. But what's one reason that's pegged? Yep. Okay, that's correct, but I don't think that's the main reason. Like, why do you think China might want to peg its currency? Yeah, good. So this is like an economics discussion, but if you have a very, let's say you have a weak interest rate, sorry, a weak currency, right? It means that your export on the global scale becomes relatively cheap, right? Do we all get that, right? And China is a huge exporting country. So China would like its exports to be very competitive. Therefore, they love to peg their currency against the US dollar so that everything that US exports is always going to be a bit more expensive than what China does, right? Maybe a lot more expensive, but that's like the main reason why China does it, right? And a country like China would like to export at a very high volume, right? Yeah, I'm kind of digressing here, but here is the USD CNH. Do we know what CNH is? What's CNH? So USD is US dollar, right? What's CNH? Any guessers? Well, if you look at the number, right? A lot of Chinese people in here, like that number kind of looks like USD to Chinese yuan, right? So CNH is the Chinese yuan equivalent, but traded for foreign exchange. So for some reason, you can't trade Chinese yuan directly. So therefore, people trading Forex will trade that, and that is going to be 1-to-1 to Chinese yuan. Okay. Probably because that the Chinese yuan is pegged, which means you can't really buy and sell freely, right? So I hope that helps. All right, so this could be a lot of people's favorites, cryptocurrency. A lot of degenerates trading these. But the whole idea of crypto is that it's very decentralized, which means, compared to a stock, which operates on an exchange, right? That's where it's traded. It's got like a whole board of shareholders, right? The cryptocurrency is decentralized. So it doesn't have exchanges or brokers, right? It's traded on the, I forgot what the term is called. Sorry? Ledger. What's the thing called for a crypto? Like, what's the big thing? Huh? Blockchain. Yeah, sorry. I think you're right. You're probably right, but yeah, blockchain. Thank you. So everything's happening on the blockchain, right? And one thing about them is that they're mineable. So over time, the volume of cryptocurrency does increase, right? Because people are mining them all the time. I used to mine Bitcoin. Pretty fun. They often lack regulation, right? Because of this, right? There's nobody looking after crypto as much as, like, say, stocks, right? Which means they can be highly volatile. So very dodgy stuff can happen. Do we know what this is? Anyone? So look at the price. It went to 0, right? But it was at 1 very consistently. What is this? Luna? Yep. What happened in Luna? Well, let's say it in like layman's terms. What happened? Yep. So good, stablecoin. So Luna has something called a stablecoin, which means, like, in simple words, the coin always has a 1-to-1 relationship with the US dollar, right? So every coin is always going to be worth $1 US. And how they maintain it is that they'll be actively buying and selling the coin, right? So let's say the coin goes to like 95 cents, and like the second, they'll be buying a bunch, increasing demand, and pushing the coin back to $1, right? And vice versa. If it's higher, they'll sell. And what happened was, I believe somebody just sold a bunch, right? So somebody sold a bunch of Luna. I don't think, maybe it was an attack on the little like ecosystem, but they sold a bunch, the price went down, Luna was actively buying, right? But Luna ran out of money to keep buying it. So then the thing just went to 0 because everybody was selling, right? Like, imagine buying this stable coin you see that the value goes to like 75 cents, obviously you want to sell, right? You're scared of it going all the way down. So everybody's doing that, and then it went to zero. So it's one of the disasters in the crypto world. But some more stable coins that we have down here, Bitcoin and Ethereum, these are like the two biggest ones that people trade, and they're often mined. Okay, any questions on this? Okay, so let me ask something, like given how volatile crypto is, why do you think market making firms want to trade crypto? Why do you think that is? So like, given that this can happen, right? And if you're a firm, you can lose all your money potentially by participating in this. But why would they, why are they going into this at all as a firm? Huge profits, yep, that's correct. But where do the huge profits come from? So thank you, Hugo. Sorry, Malay. Where do the huge profits come from? Sorry, deflation, no. High spreads, no. Retail flow, yes. So like I said before, right? A bunch of degenerates on the internet trading crypto, right? That's just a fact. Like there's people on Reddit just trading like millions at a time, right? Like this is a very easy way for people to gamble, because trading crypto requires no fundamental, say, finance knowledge, right? Like it's going to be way more fun than trading. It's like Apple, right? Which is very boring. It's like it doesn't move as much. So this is a very popular way for people online to gamble, which means there's going to be a lot of retail flow, right? A lot of dumb people making dumb decisions, and that means profit for market makers, right? And as long as you watch your risk, you can easily make a lot of money from this. Okay, so retail flow is going to be the driving factor of this. Cool. Any questions? All right, perfect. Now we're going to be talking about something called derivatives. This is just like the derivatives in math. These securities would rely on the underlying assets, right? So their prices are kind of determined by the underlying assets. Okay, for example, you have something called forwards and futures, and you can have a future on a stock, or you can have a future on a commodity, right? That's why they're called derivatives. But what a forward contract is that it's an agreement to buy and sell an asset at a specific price at a determined date, right? So let's say that I'm a farmer and I have a bunch of coin this year, right? Let's say I produce like a 1 ton of coin, right? As a farmer, you don't really want to be like exposed to the moving prices, right? Like maybe one day corn's prices will go to zero, and then I don't really want my family to starve, right, for that year. So what I might do is I might do a forward contract with someone like, let's say Patty wants to buy my corn. And what that does is that essentially locks in the price, right? So I'm going to tell Patty, in 6 months from now, I'm going to sell my corn to you at, say, $10 per kilogram, right? Might be very cheap. Okay. So in doing so, I get to kind of be safe from the risk of the price, moving up and down as a farmer, right? And Patty maybe gets to get a favorable price in exchange, right? So that's called a forward contract. And it's often sensitive to interest rates and dividends. Why do we think that is? So maybe let's move away from the corn and let's talk about, say, like Apple, right? Like we have a forward on Apple, forward contract on an Apple stock. So why do you think that is? Like, why do you think forward contracts are sensitive to interest rates and dividends? Do you have an answer? Yeah, Ben, you can speak.
Yeah, right. Because dividend will impact the stock price. Like if you pays out dividend, the price is going to go down by the amount of dividend paid.
Okay, that's okay.
In terms of for interest rates, like interest rates will impact the cost of borrowing. Forward contract is basically like you're borrowing it to like you get to pay it later. So you get to pay your payments.
So do we all understand him? Yeah, all right. I'm gonna put what you said in an easier way to understand. So with dividends, right? Like I said before, dividends is something I receive if you hold the stock, right? Let's say I buy a forward contract for 1 unit of Apple, that's in 6 months, right? And let's say Apple is going to release its dividends in 1 month. I wouldn't be owning Apple when the dividends are out. Do we get that? Okay, so do you think the fact that Apple is releasing dividends is going to make the forward contract's price go up or down? Because I know this is a very complicated question, so I'll rephrase it. So we are buying a forward contract. So that we can buy Apple in, say, 3 months from someone else, okay? And we know that, and everybody knows that Apple is going to release its dividends in 1 month. And when I buy the forward contract, I'm not actually holding the stock until the end, right? So let's say there's dividend 1 month in, would that make the forward contract go up or down in terms of price? Patty, how about you? Goes down? Yep. Do we all understand why, right? Because if you buy the forward contract instead of buying the stock, you're going to miss out on the dividend in 1 month, right? And that will push the thing down. Okay. Does that make sense? Now, what if it's the same scenario, and then between now and 3 months, there are very, very high interest rates? Would that make the dividends price go up or down? Sorry, the forwards price go up or down? Patty, you again? Sorry to put you on the spot, but you're a trader, right? You should know this. So very high interest rates between now and 3 months. Does that make the forward contract more or less attractive? More attractive, yes. Why is that? Okay, so this is more about the interest rate, less about the dividend, but that part we already discussed, right? Holding costs, yes. I think the easier way to put it is that, like, the main difference between buying the stock now versus buying a forward contract for 3 months is that the cash flow happens later, and we don't actually trade until 3 months, right? So then, let's say I put away $1,000 to buy the stock. That $1,000 still belongs to me as I'm sitting on this forward contract, right? So between now and 3 months, I can put that into maybe a bond, maybe a savings account, right? And then I can profit from the huge interest rates, right? So then that might make the forward contract go up in terms of price, because it's now more attractive to buy the contract, save my money, instead of buying the stock and spending my money right now on the stock. Okay, hope that put that in enough easy terms. Do we get that? Okay. But yeah, some discussion on that. Now, forwards are traded over the counter always, and they have flexible terms and conditions, right? So I can say, I can give like I have a lot of flexibility in choosing what the terms are. For example, like 1 ton of corn, I could do like 995 tons of corn, right? Or like 6 months versus like 4 months and like 20 days, right? So you can really be very flexible with the forwards just because it's a 1-to-1 deal, right? Like I'm trading with Patty over the counter, and there's no one else involved, right? So then we can decide what's best for both of us. And the alternative to forward would be futures. So these are basically standardized forward contracts. So standardized meaning that, for example, with the duration, you can, like I said before, forwards can be like 4 months and 20 days, whereas futures, they have set dates, right? Like 1, 2, 3, 4, 5, 6 months, like that. So they're very standardized. Like even with the size, right? I could trade 909 tons with Patty, but then with the size, you might have to do like in increments of 50 tons, right? With the corn. So these are standardized for a reason, so that people on exchange can trade easily, right? Like nobody on the exchange wants to like scroll through thousands of prices, thousands of dates, right? It just becomes very annoying. Okay, so these guys all have forward contracts. Like these are guys all forward contracts, but the futures are basically forwards traded on the exchange. Okay, we're happy with that? Yep.
If the payoff for a future and underlying security is the same, why would you purchase the future?
All right, can anybody answer him? Why would you purchase a future if the payoff's the same? I can tell you wasn't listening because I explained earlier, but
futures you pay at the moment that you buy, like you don't pay at the end. It's not because
yep. Oh, sorry. Yeah, sorry.
yeah.
My apologies. Yeah, why would you buy a future over a stock itself? Can somebody tell me?
More like insurance.
Yep, insurance, right? So going back to the example where I'm a corn farmer, right? The futures price is easily derived, right? There's some relationship with futures, with the underlying price, with the commodity, the interest rates, right? And dividends. You can easily derive the price of the future. And I might buy the future now so that I can lock in the price, right? So that I'm not going to be, exposed to the fluctuations in the corn prices if I'm a farmer, right? I don't want the risk. Okay, so that's like the main reason why people trade futures. Can we think of another one? What's something else you can do with futures? Hedge. Okay, hedging is essentially making a trade to reduce your risk, right? So let's say that you're long, like you bought 1 unit of Apple and you think you bought at a very good price, okay? And you don't want to be, again, exposed to the fluctuations in the prices, and then you can hedge your risk by selling a unit of the Apple future, right? So then every time the price goes up, the future goes up as well, which means you're going to be making that money regardless, right? So you're hedging your risk. Okay, that's pretty complicated, but you can do some research on that later if you're interested. Another reason that I think is important is that with futures, you can short, right? You can short very easily. So because that the forward contract is, it's done at a later date, right? If you remember me saying before that if you want to sell stock, you might have to borrow from someone else, sell it, and then that achieves your shorting, right? So that process can be quite complicated and costly, right? Because you have to borrow the stock from the person, pay them borrowing rates just to short it. An alternative is to sell the futures, right? So then because you can sell future contracts without actually owning the stock. And then later days, let's say 3 months from now, you can buy the stock anytime to, pay it to give it to the person that bought your futures, right? And then you've effectively shorted it between now and then. Do we understand that? Okay, so that's one way you can use futures to short. What happened here? Anyone? So the price went negative, right? And this is a future on a commodity. Huh? Yep, good. So this is what's crude oil in the beginning of COVID. So basically what happened was crude oil is a very popular commodity for things like nail polish, soap, perfume, right? And as you all know, like during COVID, the demand for everything globally decreased by a lot, right? So what happened was that the companies that were buying crude oil futures, right, suddenly ran out of storage space for the crude oil. So now they have a bunch of futures on their hands and their warehouses are full, right? And they want to sell their future because if you own the future, if you own the forward contract at the end of the date, you have to accept the delivery of the crude oil, right? But then these guys, they ran out of space in their warehouses. So everybody's trying to sell because of that, and then the price went negative, right? So it became more profitable or less costly for the companies to straight up sell the future for a negative price than to accept the oil and then do whatever with it, right? Like imagine like millions of barrels of oil coming at you. You have no space, right? It's very complicated. So then the price went negative. Does that make sense, everyone? Right. So that's because a lot of people are trying to sell, right? A lot of supply, which pushes price down. All right. Fun discussion. All right. Now we have options. This is one of my favorite derivatives. So an option, just like the name suggests, it gives you the right, but not the obligation to buy or sell an asset at a specific price at a specific time, right? So call option allows you to buy. And these are the main variables of an option, right? Obviously, you have the underlying asset, that's a variable. The two most important ones are the strike price and the expiry. And then the type of the option, which is call or put, okay? So one example is, let's say we're going back to the Amazon stock and I can buy a call option at a strike price of say 120, which expires in 3 months. Okay, so assume this is a European option, which you can only execute at the expiry date. Okay, so I might buy the call option at a strike price of 120, which expires in 3 months. So between now and expiry, I can't do anything. I can trade the option, obviously, and then at expiry date, I have the option to either execute or not execute the option. Does that make sense, everyone? Okay, so let's say that the option goes to like 150 by the end of 3 months. Would I execute this option? So the strike price is the price that we're buying at for the call option for context. So now the Amazon stock goes up to 150. We have a call option at 120 strike. That's for us to execute. Will we execute it? Yes, right? Why is that?
If you can buy that 120,
Yep, exactly. So you're making that $30 of sort of profit in a way, right? When the price is good, right? And vice versa, if the price goes very low, we don't have to sell the option, right? So what's like a benefit of the options? Looking at this graph, that's pretty much what happened. As opposed to a stock, like what does the option provide you with? What do you want to tell me? Yep. Yep. So one way you can put it is that you have limited downside and unlimited upside with that option, right? So then, as soon as the price hits, let's say we bought the option for like $1, and this will be 120, right? That's a strike, and that's 121, right? So then you see that as soon as the stock hits 120, the option is a straight line, right? This is a straight line with the slope of 1, right? Just like the stock itself, right? So that will give us the upside exposure of just buying the stock, right? So then, but then if the stock goes down, goes negative, the maximum that we can lose is what? What's the maximum we can lose on a call option? Exactly. So how much we spent to buy the option, because at the end of the day, we can just choose to not exercise it, right? Which means we lose the minimum. Okay. Guys, excuse me. All right. So a couple of trick questions before I move on to this. What is the maximum that you're willing to pay for a call option? Okay, so I think you two know a lot. I'm gonna try to have other people. The maximum price you will pay for a call option. So I think everybody understands the variables, right? Any guesses? What's the maximum price you'll pay for a call option? Victor? The maximum price you'll pay for a call option. Yep, call option. Yes, the price of the stock, right? Do we all understand why? Okay, it's because if you want to be exposed to this, you can also get the same exposure by buying the stock, right? And then if you're willing to pay for something more than the stock, just to minimize the downside, it's kind of silly, right? Because you're already paying for the stock. So that's like the maximum. So, and we also call these arbitrage bounds, right? So that's like the maximum price that you'll see an option being sold or bought, right? Okay. What is if you look at a put option, right? A put option would be the opposite. So put option will give you the rights but not the obligation to sell a stock at a specific time at a specific price. So what do we think the maximum price of a put option is? Okay. Sophia, what do you think? Maximum price of a put option. Have a guess? Not the price of the stock. Guys, please, we're about to finish up, okay? 15 more minutes. Not the price of the stock. The answer is the price of the strike or the strike price, right? It's because the maximum that you can make with a put option is if the stock goes to zero, right? Then you make the strike price. So you can't make anything more than that. Therefore, you're only down to pay that much. Okay. Yep. That's right. So we're buying and we're selling at, right? So let's say you have a put option, and at the end of the expiry, the stock goes to zero, right? Would you execute your option? Would you execute it? Why wouldn't you? Right. So remember, you're selling at the strike price, not at the stock price. So you would, right? Because that allows you to sell it for whatever the strike was, and you could buy it back at zero, right? Then you make that much. And that's the maximum amount of money you can make, right? Cool. So there's something called the Black-Scholes model, the BSM for options. What it does is it has a bunch of variables like these guys. It's got strike price, expiry, underlying price, the type, plus the interest rates, dividends, and volatility, right? And this is a way for you to price your options just by plugging numbers into an equation that's well derived, and it'll give you the theoretical price of an option, right? And it is said that trading options is the same as trading volatility. So why do we think this line is true given this? Okay, so we were able to derive this line from all the information up here. Why is that? Yep.
Because there's a limited downside when you're buying options for unlimited upside. So the higher the volatility, the higher.
Okay, yes, but given the Black-Scholes model, right? So sometimes when you hear traders talk, they'll say, instead of saying I paid $2 for an option, they'll say I paid 20 volatility for an option, right? So why is that? Like, why do we use volatility as an alternative to price given this? Anyone? You two want to have a go? So why is this true given this? It's a tricky question. That's correct. Yes. So options love volatility, right? Because the upside could be very large and the downside is capped. Yes. However, the correct answer is that given what the model has as variables, right? Notice that strike price, expiry, underlying price, interest rates, dividends, everything but volatility is pretty accessible information, right? Like you can't really argue with someone on what the strike price is or what the underlying price is, right? So everybody is able to get these inputs, right? Maybe interest rates is a bit, ambiguous, but there's always a way to get these inputs. But everything but volatility, right? So there's no way for you to say, go on the internet and search what's the volatility in the next 3 months for Apple, right? It's impossible. So that's why trading options, trading volatility, right? Because all of these guys are fixed pretty much. So everybody knows them, right? Does that make sense? Okay. And like if the option was priced at some like say X dollars and you have all of this, right? From the X dollars, you can put it back to the equation and get the volatility back, right? To say, trading the option at X dollars implies a volatility of something percent, right? And we call that implied volatility given the price. Okay. So I don't want to talk about this too much, but you can feel free to read more on it. If you look at the top right of the screen, this is an example of an order book for an option. So the main things you see is underlying stock you're trading, right? The derivatives or the option, the stock for the option, right? The expiry dates, and then the strike prices. So these are the main, I guess, variables for different option products, right? And you see that every one of these strikes, every one of these expiry dates, right, has different products. So it shows you how broad the market is, right? Like there's so many things being traded at the same time. Like just for one stock, you have like hundreds of option, say, varieties, right? Any questions? I think we're near the end. Okay, this is the last slide, so good to go. All right, finally we have ETFs. So this is some people's favorites. What ETFs do is they track a financial asset, right? So the most popular way to make an ETF is to track an index, because an index is a basket of stocks, and an ETF is a way for people to trade the index over the exchange, right? So when you say you're buying index funds, right, you're actually buying the ETF. So the exchange allows you to buy these indexes, right, or to long or short these indexes. So here are some examples: S&P 500, Dow Jones, HSI, the Hang Seng Index for the Hong Kong exchange. And since the index, we're just going to talk about the index, the ETF index ETFs here. They can be, since the index consists of a basket of stocks, right? They can be created or redeemed. So you can create an index by getting the basket of stocks, right? And boom, you have your index. Or you can redeem it, which means you take your index and you can break it down into a basket of stocks. So these are all operations you can do as a participant in the market. But some benefits of indexes would be diversification, right? The index is a basket of stocks, so if any one of them goes up or down, not that exposed. And they would be cheaper than buying all the stocks outright because of the transaction fees, right? So if you want to buy all the S&P 500 stocks, you might end up spending a lot of money because every buy represents a fee, right? And they're actually technically not derivatives because they do not, well, like they do not depend on the price of an underlying asset, right? Whereas they're literally the underlying asset. Does that make sense? So you're buying an ETF on an index, right? You're actually buying the stocks themselves. So it's not really derivative. And yeah, this is the S&P 500 as an example. And as you can see, it's not very volatile, right? This is like every year, so it's quite stable. Cool. So that is the end of the presentation. Do we have any more questions? Yes, of course. So usually what they do is there's different ways to weight the ETFs, right? So there's like index weighted, price weighted, a bunch of different ways to weight it, and it's up to the issuer to decide how you weight it, right? So if all of a sudden Apple is becoming huge, right? Let's say like you have a tech ETF, tech index, and then one of them suddenly jumps up a lot, right? The next year, that stock itself might have a higher weight than the other ones because of its impact, right? So I'm going to try to find a slide of all of our social media places. I think there was somewhere. But yeah, do we have any final questions before I wrap this up? Okay, anybody online have any questions? So I was supposed to, give me 1 second. Let me find the page I want to show. Bear with me, everyone, please. Huh? Is it? I couldn't find it. You want to help me, Patty? Oh, sorry, I found it. Channels. So, yep, if you enjoyed the presentation, please give us a follow on our social media pages. So, here it is, right? So give you a link of all of our social media pages. And yeah, like I said before, our education portfolio, we're releasing questions like brain teasers. And if you answer them correctly, you can potentially win hundreds of dollars in gift cards. And this is starting tomorrow. So please make sure to stay updated, give us a follow, and look forward to talking to you again. All right, thank you, everyone. Yep, so the meeting will be recorded. We will release it online somewhere. We will let you know. So please give us a follow. Could be YouTube, could be, say, some Drive somewhere. How do you become a member? Just sign up to our Facebook, join our Discord, right? But yeah, like being a member of SQD is just coming to SQD events, right? Everybody's welcome to be a member. Any resources for getting into a trading firm? I think just do your research, right? So this is people online asking questions. Do your research, maybe Reddit. I think Reddit has a lot of good resources. Come to our events, right? And yeah, I think if you just work hard, come to our events, have the information, you can easily get in. You can't really comment much on that, sorry. How do you become a trader? Well, you can apply as ideally a STEM student, right? If you're interested in, everything I talked about today, if you're interested in the financial markets, you can apply, come to our society events, we'll give you resources, do your research online, right? And, all of our sponsors are on our websites, and you should be able to easily, sorry, I'll show you one more time. So maybe just keep in mind of all the names that I've shown you, right? Like you can go to our website, sydneyquanttraders.com, sponsors, and all of them are hiring on a yearly basis. So feel free to apply to any one of them. Okay. So yeah, thank you, everyone. Yeah, just apply, prepare for a bit, and you can get in. Yeah.